In general, I'm not really someone who typically thinks negative on stocks. A lot of people would refer to me as a permabull, someone who is always looking for increasing value companies and stocks that are going to fly to the moon, including the companies that I own. Obviously, the 4 companies that I buy stock in, I believe will do great over the next 1, 3, 5 years. I believe that Salesforce, Amazon, Google, and Crocs, every single one of them will be great stocks, regardless of where their stock price goes in the short term. And it's rare that you ever hear me talk about shorting companies. But this is one that I'm considering. And I've shorted many companies over the last year or two. I've shorted big names like Lucid and Bill.com and Nikola Motors and many other big names. But Carvana could be the next target. And it's easy to look at this 1-year chart and see it go down 95% and think, wow, this stock has got to be at a bottom. I'm not so sure. We're going to talk about in this video why that might not be the case, why this exploding revenue growth over the last couple of years may not be sustained, and more importantly, regardless of whether or not revenue goes up, that's irrelevant because the big problem we have here is negative free cash flows, exploding debt levels, and overall, what I consider to be a failing business model. So if you want to look into Carvana, if you want to take an overall view of this company, and if you're invested in it, I think you should be concerned. We're going to address these concerns in this video. You can rebuttal these back to me if you think that I'm wrong or incorrect, or maybe I'm missing something. So if you think that I'm wrong, and you're saying, Jordan, this company is going to be a rocket to the moon. If you think this is going to be an incredible stock, well, we're going to talk about that here in this video. So thank you guys for tuning in. And without further ado, my name is Jordan, the Millennial Investor, and this is my portfolio balance right here. This is my portfolio holdings. My performance year to date since the last time I updated this at the beginning of the month. We'll be updating this in the next video, by the way. My monthly YouTube income, my lifetime YouTube income, and then of course my portfolio balance, which is about $38,000 change as of the time of me filming. And here's my performance year to date as of the time I joined this brokerage. My portfolio holdings, which is down below in the description. You can directly see yourself in the description, and if you want to get signed up with M1 Finance, you would help support me in the channel. So if you found value in a video like this and you want to help support me, you can do so like the 132 people I've done so far. So without further ado, let's go ahead and look up Carvana stock and get started into why I think that this company is, honest to God, going to be bankrupt within the next half decade. So let's go ahead and get started. Over the last 5 years, this company was an incredible performer. Going to the peak back around August of 2021, at one point this company hit almost $400 a share. It was around $360 at the peak. And if you would have invested 5 years ago and held throughout the peak at $360, you would have had 2,726% gains. You would have 27 extra money. Just for an example, if you would have bought $1,000 worth of the stock at IPO, then you would have had $27,000 in August of 2021. However, you've seen a big downturn. In the last 2 years, it's down 93%. In the last 1 year, it's down 95%. Way off of those all-time highs, dramatically lower. And I think the issue with this company has not been its revenue growth. The revenue growth has actually been quite incredible, very above average, I would say, especially considering this is not some tech or software company. You see that originally in 2015 it had $0.13 billion, up to $0.37, the $0.86, $2 billion, $4 billion, $5.6 billion, and then last year's incredible $12.81 billion, and now revenue growth is finally starting to slow. The most recent quarter still grew quite nice at 16.4%, but this begs the question, will this revenue growth keep up? And here's the problem that I see investors fall into. This is the trap that I see over and over and over again, and even I have made this mistake myself in the past. I'm an investor that has grown, I've adapted, and I'm constantly reinventing my ways to look into companies and change the way that I see investments for the long term. And over the last year or two, something that I've really come to realize is that honestly, if a company is not profitable, or you can't see the vision for them becoming profitable within the next couple of years, then what is the company's value? Because it becomes much more difficult to determine what a company's value is when they don't make profits, mostly because there's not much value at all. Now you see updates like this, they just posted this not too long ago, a couple months ago, talking about the increase in car vending machines, the total markets at the end of the period, the retail units sold, and then the total revenue, which is still growing. However, The losses, if you notice these chart on the right here, here's where it gets interesting. Now I want to stop on this picture right here and I want to jump back into Qualtrim and I want to take a look at the free cash flow. And this is what I find most concerning. Have you noticed that as the revenue chart has gone up and to the right, they've continued to scale their business, the profitability has not done what a typical business does. It has gone down and down and down. Now let me give you an example. You can see that over time, the losses have not decreased, they've actually increased. They've steadily lost back here around 2017, 2018, around $100 million or so a quarter, and then it's increased and increased ever since then, and now some quarters they've exceeded $1 billion in losses. This quarter at the end of 2021, $1.33 billion in losses. The last quarter, $0.8 billion, and then last quarter they shrunk it quite a bit, but still not going in the right direction overall, the long-term trend. Now the thing is that as they've had these losses, let's look at the cash pile, okay? You see that it stayed pretty much steady for years on end. You did see a big uproar right here, but you might be saying, okay, they're finally getting things under control. They're expanding their cash pile. Well, the only reason it looks like that is because this debt pile is growing in a huge way. Last quarter, they increased the debt pile by $3.4 billion. And if you compare these side by side, the cash versus debt, it becomes very apparent which is growing faster. You see that little bitty green line at the bottom there? It's really hard to see. You might have to squint your eyes. So if you need to put on your glasses or your contacts in, that little bitty green line down there is the cash. And then this giant red pile that it's growing much faster is the debt pile. And it doesn't seem to be getting better anytime soon. And so this leads me back to this presentation, this slide, which I want to highlight right here. The only way that you ever see a company like this ever get profitable is scalability. You see the different inspection centers and the different car markets and the different the car vending machines that they have located all over the country. And they're doing good so far. They're expanding. They are growing. But the only way you see a company like this really reach profitability is scale. And you might be saying, Jordan, how do I know that? Because this reminds me a lot of a company that I'm actually invested in, which is Amazon. Now, Amazon lost money for years. If we pull up the annual charts here, this is a company that didn't make any money at all for decades. Going back all the way to 96 when this chart started, they either made little money or lost money every single year, honestly, until about 2016. They finally started to turn profit margins around. If you look at these ratios here, we pull up the ratio chart and we pull up profit margins, you can see that they used to be awful. Even some of their best years back in the day, this company has always ran at teeny tiny profit margins. And then when did this company really start to hit profitability? As this revenue chart scaled up, the only time profits really started to go up was around the time they reached scale, which in this case was around 2016. You finally saw an uptick from 2 billion to 3 billion to 10, 11, 21, and now the most recent $33 billion. It is scaling dramatically fast, grew 56% year over year. And if you look at Amazon, a prime example, this is a company that has reached scale in a big way. Look at this distribution center map of comparing 2021 to 2017. You see 2017, they had a lot of locations spread around the country, but now do you notice the dramatic difference? There are so many cost synergies that are related to companies like this when they have it spread around all these different markets, around all these different locations. There are so many different cost synergies that you can get, and obviously when you're building the web infrastructure off of your own services, AWS, you get a huge bump, a huge advantage. And you might be saying, Jordan, you're an idiot. They're going to do just like Amazon. They're going to build all these locations. They're going to raise money. That's what they're doing this debt. That's why they're raising this debt. Why would they not raise all this money? Why would they not build out all those locations? Well, here's exactly why I know that's not going to happen in my opinion, and it's for two main reasons. The first one, going back to the free cash flow like we said, this company has never, literally not even a quarter, even during the 2020 boom when everyone was at home, 2021 when car prices skyrocketed, this company never eked out a profit. During the best boom time you could imagine for a company like Carvana, an online car company, when people cannot go to car lots, they're stuck at home, this is the time of the life for a company like this. So that's the reason number one, is that this company can't even make a profit during the best of times. During the worst of times, who knows how bad it will get. Now let's look at this debt pile and compare that to Amazon's history when they were scaling. Looking at now, you can see that the cash pile for this company, originally starting out good when they IPO'd with no debt, and they've slowly raised debt over time. And they originally had a big cash pile, and it's gotten worse and worse and worse every single year. And if you compare that to Amazon, that's not how Amazon operated. Pulling up the annual charts here for Amazon, we can look at the most recent numbers, but what I want to look at is when they were scaling the business, which is what we want to compare for Carvana. You go back to the 90s when this company had minuscule revenue compared to today. Go back to 1998. They had 0.37 in cash, 0.35 in debt, so about identical. Then it was 0.71 to 1.47. They had a little bit more debt, and a couple of these years in the early 2000s, they had a little bit more debt, about $1 billion, nothing too crazy. But over time, when we get to 2004, they even it out. 2005, they start to exceed it. And then as we go from about 2007 and on, you can see that over time it gets dramatically outpaced that of the debt pile, and the cash pile grows significantly faster, now reaching about a $96 billion cash pile as of the end of the year. Now, Carvana is not doing that. Their cash pile has already burned out, and they're not even close to reaching the scale of a company like an Amazon. Not to mention, cars are much harder to sell, and they're a lot bigger and bulkier items. And this leads me to the issues that I see, because even Carvana themselves, and they're pitching this as if it's a positive, which it kind of is because the losses will stop short term, but that means long term they're going to sacrifice the business. They're talking about the big positive is that the quarterly capex is going to go down, which the whole point of getting this company to scalability is the only way you really get it profitable. And now you see deals like this, raising debt. CapEx is being charged at a 10.25% interest rate. You see at this debt pile, not only is it growing, it's getting bigger by the quarter, bigger by the year, but the reason why this is so detrimental is not just because the pile is getting bigger, the interest rates are also going up. Every time they raise debt, it gets a little bit worse. And now they're raising debt at double-digit interest rates, 10.25%. That is extremely expensive, and just this one raise alone will cost them over $100 million in annual interest expense. Go ahead and look right there, right in the blue where I'm highlighting $100 million, bam, right off the free cash flow just from this one raise alone, and this doesn't even factor in all of their other debt that they already have, which is now hundreds of millions of dollars. So I think the scalability that a company like Amazon reached is not even comparable to a company like Carvana that I think will frankly never reach it. So I think it's very easy to look at a chart like this and say, oh my gosh, it's down 95%, it can't go any lower. I'm not so sure. That it's 93% down year to date, could get better. I think it has a chance to get better in the short term because it's gone down so much. But long term, on a 1, 3, 5, 10-year basis, I think that this company is likely destined for bankruptcy. So it's for these reasons why I'm considering shorting. The only reason why I haven't yet is because I'm bought so heavy into these 4 companies that you see right here that I'm frankly out of money. If I had money sitting on the sidelines right now, I would likely be shorting a little bit of Carvana. And if we see an uproar, if this company goes higher, already past a pretty high $2.5 billion market cap for a company that can't generate a profit, if this company goes higher, if it goes to $20 a share, $25 a share, $30 a share, then you'll probably see me load up on shorts higher and higher as the company goes up. But in the meantime, thank you guys so much for watching. I appreciate you watching all the way to the end. Get signed up with M1 Finance if you haven't already. And without further ado, my name is Jordan. I'm a millennial investor, and I'll catch you guys next time.